To help you with this question, let's think through the requirement together. Now let's deal with question 7 first. Question 7 is asking you what leads to the change in the capital of a business based on some transactions that you are given. So it's important to notice the key word here, the change in capital. Now we know that capital of a business is made up of the opening capital, to which if there are any profits made during the year, you would add, and you would deduct any drawings, and this ultimately will give you the closing capital. Now, with that in mind, what you want to do is you want to have a look at these transactions and think about whether or not that's going to directly feed into the capital account, okay? Now, if we start with transaction 1, which is the purchase of goods on credit, the dual impact is that you are debiting purchases and you are crediting payables, okay? Now, purchases is an expense category and payables is a liability category, okay? Now, although when you buy goods, you are essentially increasing expenses and reducing profits, this transaction does not directly feed into capital, as we can see from this equation here, okay? Because capital is opening capital plus profits less drawings, okay? So less the drawings to give us the closing capital. So transaction 1 is not going to be one of our answers. Now, looking at transaction 2, it refers to profits earned on trading. Now, if we knew this capital equation, we could quite easily have just selected option 2 as the answer, okay? Because when profits are made by a business, what that is suggesting is that sales are greater than the expenses, okay? And sales are typically on the credit side, expenses would be on the debits, implying that our credits exceed our debits, okay? This means that profits will sit on the credit side initially, okay? But when they are transferred to the capital account, what we're doing is we're removing it from the credit because profits imply that credits are higher, okay? So you would remove it from the credit and you would post that instead to the capital account, okay? Not necessarily relevant for your sort of technical understanding here, but for completeness, what you're doing is you're debiting, okay, the profit account, and you would be crediting capital, thereby confirming that transaction 2 does lead to a change in capital. When you then come on to the third transaction, okay, I know we've already selected the answer, but for completeness, when you purchase goods on cash, yes, you're debiting the purchases and you are crediting cash. Again, this is not directly impacting the capital account, okay? So it's not option 3. And option 4, the repayment of a loan would result in a debit to the loan account. You are thereby reducing a liability and you'd be crediting cash or cash at bank to show that repayment has been made. Again, this transaction not directly impacting the capital. Now, what we're going to do is in a similar way, think about the next question, okay? And how that is phrased differently to question 7. So if we move on to the next question, what we have here then is question 9. And in this question, you're being asked to think about the change in net assets. So specifically here, you need to think about the accounting equation. The change in net assets implies assets minus liabilities, yes, is equal to capital, but it is also equal to net assets. So in this question, you want to look out for the transaction that is going to result in a change in the assets and the liabilities such that the net impact is not nil, okay? Now, if we start with transaction 1, sales on credit, the dual impact is to debit receivables and to credit a sales account. Okay, now if we think about the receivables, that is an asset category ledger, and the sales is going to be part of your profit. Okay, ultimately, it's going to feed into the capital section. It is an example of an income ledger which feeds into your profit. Now, in this equation, it is instantly obvious that the asset side of the equation will change. Okay, and so as a result, it is option A that is the correct answer. We've already found the correct answer. Now, if we continue to read on, okay, and I'll just confirm why it's not the other options. Option 2 talks about capitalization of payments to improve an asset. The phrase capitalization of payments simply means you are increasing the value of a non-current asset. Let's just pretend that non-current asset is a factory. So you'd be debiting the factory, its payments, so you're going to be crediting cash. Now, the factory is an example of an asset ledger. Okay, so we're going to have an asset category, and the cash is also an asset category. Now, if both sides of this equation are increasing an asset but simultaneously also reducing an asset category, the net impact to net assets is 0. It cannot be option 2. Moving on to option 3 then. And what do we have here? So option 3 is payment to a supplier. What we're going to be debiting here is the payable to reduce for the amount that is paid. And we're going to be crediting bank because it's by electronic transfer. Now, the payable is a liability category, okay, and the bank is an asset category. Now, again, if we think about the accounting equation, assets minus liabilities, you are changing a liability, okay, you're changing an asset. So again, the net impact is nil. Okay, so it cannot be option 3. Finally, option 4 talks about payment received from a customer. You would be debiting the bank and you're crediting a receivable. And a bank is going to be an asset category, okay, and a receivable is an asset category. But what's happening here is you are increasing an asset category, but you're simultaneously also decreasing an asset category. Again, the net impact is going to be nil to net assets, so it cannot be option 4. The distinction to make is that question 7 is about capital, question 9 is about net assets. Two very different questions.